Okay, remember that market shock last summer, August 2024, seemed to just bam, hit out of nowhere.
Oh, yeah. Triggered by something happening way over in Japan, of our places.
Exactly. And it wasn't small, right? It sent ripples, serious ripples across global markets. Stocks, gold, even Bitcoin took a hit.
Definitely. And, the sources we've been digging into for this deep dive, they're suggesting that wasn't just some, like, weird one-off event.
Right. That's what caught my eye. These articles, analyses, they seem to be pointing towards Japan's financial system, specifically its huge government bond market,
Yeah, the JGB market.
that it might be signaling something, well, deeper this time, maybe more systemic.
That's the gist, a potentially bigger stress point building up.
Okay, so let's unpack that. Our mission today for this deep dive is to sift through these sources. We've got market reports, expert commentary, analytical pieces, the whole range, and really figure out what is going on with Japanese government bonds, JGBs.
Right. Why now? Why the stress?
Exactly. And why should someone, sitting outside Japan even care? What could it mean for the global financial setup? And yeah, maybe even for assets like Bitcoin. We'll try and break it down, keep it straightforward.
Sounds good.
I have to say, digging into this, the connection between like Japan's domestic bond market and global finance, let alone crypto, it felt pretty surprising at first.
It really is a fascinating web, isn't it? Shows just how interconnected everything is. A wobble in one corner can definitely shake things up everywhere else.
No kidding. So let's rewind just a bit. Back to that August 2024 event. It really did feel like a bolt from the blue for a lot of people in the markets.
It did. The Bank of Japan, the BOJ, they made what looked like a really tiny move. Just nudged their target interest rate from 0.1% up to 0.25%.
0.25% sounds like nothing.
On paper, yeah, tiny. But the reaction, whoa, anything but tiny. Sources described it as triggering this, like, sudden, sharp sell-off across global assets.
Yeah, I remember seeing one source call it the central banking equivalent of a Thanos finger snap.
Yeah,
Gives you an idea of the speed, right? Japanese stocks tanked, gold fell, Bitcoin dropped, U.S. tech.
a global liquidation event, they called it.
And the underlying reason, according to the sources, was this thing called the yen carry trade suddenly unwinding.
Exactly. That's the key. The yen carry trade getting violently unwound.
Okay, yen carry trade. Let's break that down. It sounds complicated, but the concept's actually pretty simple, right? Here's an analogy I was thinking about.
Go for it.
Imagine you've got a friend, right? And this friend lends you money for almost zero interest, like 0.1%. Super cheap.
Okay.
But you can take that same money and stick it in, say, a high-yield savings account or invest it somewhere else and make, I don't know, 4% or 5%.
Right. Much higher.
So you borrow from your super cheap friend, you invest it for that higher return, and the difference, that gap, that delta in the interest rates, that's your profit. You just pocket it.
That's a perfect analogy. And that's exactly what was happening on a massive scale. For years, the BOJ kept Japanese interest rates incredibly low, near zero, trying to fight off deflation.
Meanwhile, rates elsewhere, like in the US or Europe, were much higher.
Significantly higher. So global investors, hedge funds, banks, everyone borrowed trillions of yen super cheaply.
Trillions, you said.
Trillions, yeah. And invested that money all over the world in things that paid more. U.S. treasuries, European stocks, emerging market bonds, you name it.
So this wasn't some niche strategy. This was huge.
Absolutely enormous.
Yeah.
And you also have to remember, Japan itself is the world's biggest creditor nation. They own trillions in foreign assets. Their financial footprint globally is just immense.
Okay, so that's why a tiny little rate nudge from their central bank could cause such a massive global reaction. It wasn't just about Japan's domestic policy.
Precisely. It was like pulling the rug out from under this gigantic global investment strategy that relied on those super low Japanese rates.
Suddenly that cheap loan from your friend wasn't looking so cheap anymore. Or maybe you worried they'd start charging way more soon.
Exactly. As one source put it, we always say, when America sneezes, the world catches a cold. Well, last summer showed that so much as a hiccup out of Japan is enough to give the rest of the world a heart attack. That tiny rate hike, plus the talk about maybe more hikes coming, it made the whole carry trade look less profitable and definitely riskier.
And when a trade like that suddenly looks risky, what happens? People have to get out.
They have to unwind. They need to sell those global assets, the stocks, the bonds, whatever they bought, often really quickly, maybe even at a loss.
To get the cash.
To get the cash to pay back the yen they borrowed. And that selling pressure, all happening at once, that's what triggered that liquidation cascade across markets. It wasn't just people choosing to sell. A lot of it was forced selling.
And it caught people by surprise, even though maybe there were hints like the yen falling beforehand.
Yeah, a Reuters poll mentioned that. Despite some warning signs, the timing of the BOJ's move definitely caught many market players off guard.
Okay, so that was a sharp shock. Painful. But, the main reason for the carry trade, that big interest rate difference, it didn't completely disappear, did it?
No, not entirely.
Huh.
The BOJ did try to calm things down afterwards, signaling they wouldn't hike aggressively. But the underlying tension, the sources suggest, it didn't really go away. And now, fast forward to summer 2025, new stress points seem to be bubbling up.
And this time it feels different. Less like a sudden policy shock, maybe?
Yeah, that's the sense you get from the sources. It feels more like a fundamental structural pressure building within Japan's own system.
And where's that pressure showing up most clearly right now?
It seems to be centered on the market for Japanese government bonds, JGBs.
Right, the IOUs, the Japanese government issues when it borrows money, usually seen as super safe, right? Like U.S. treasuries.
Exactly. For decades, considered among the safest assets on the planet. Rock solid.
Okay, so the issue this time isn't a surprise rate hike. It's stress in Japan's own debt market. What are the sources seeing? What's the evidence?
Well, the clearest signal is what's happening with JGB yields, especially on the long-term bonds, the ones maturing way out, like 20, 30, even 40 years from now.
Okay, yields. What about them?
The sources are saying these long-term yields have been going through the roof, hitting record highs, or highs not seen in decades.
Going through the roof. Sounds dramatic. What does that actually mean in bond land?
Well, yield is basically the return an investor demands for lending money to the government by buying its bond. So when yields go up, it means the market is demanding a higher interest payment from the government for that loan.
They want more compensation for the risk, or perceived risk.
Precisely. And it's especially telling for long-term bonds. Rising yields there suggest investors are getting more worried or uncertain about the long-term picture. So they demand higher compensation for locking up their money for decades. Seeing record highs on 30-year yields or 20-year yields at levels from the year 2000, that's not typical for something considered ultra-safe.
Right. If it's supposed to be super safe, why are investors suddenly demanding more pay? What's actually causing this pressure on JGBs?
It looks like a few major factors are kind of converging right now, according to the sources. Number one, and it's a big one, is Japan's just unbelievable debt load.
Yeah, I saw that figure. Highest debt to GDP ratio in the developed world.
By far, around 263% of GDP. It's staggering.
263%. Wow. So if yields rise even a little bit, the cost of just paying the interest on that debt must become terrifying.
Exactly. Every little tick up in those long-term yields means the government's interest bill on that colossal debt pile balloons. One source mentioned that back in 2023, something like 22% of the entire government budget
22%.
went just to paying interest on the existing debt, not paying it down, just servicing it.
A fifth of the budget. Okay, that definitely puts a constraint on things. What else is pushing yields up?
Well, another huge piece is the Bank of Japan itself changing its role. For years, the BOJ was the buyer of last resort, really the buyer of first resort, for JGBs.
Through QE, right. Quantitative easing. Basically printing money to buy bonds.
Exactly. Massive QE. They were hoovering up something like 120 trillion yen worth of JGBs per year at the peak, trying to pump money into the economy and keep yields nailed to the floor.
And they ended up owning, what, more than half the entire market?
Correct. Over 50% of all outstanding JGBs are sitting on the BOJ's balance sheet. But, and here's the big irony, after decades fighting deflation, Japan now actually has inflation.
Right. Careful what you wish for.
Indeed. Inflation's been stubbornly above their 2% target for, 3 years running now? So the BOJ is being forced to shift gears. They're dialing back the QE.
Starting to tighten, even if gently.
You know what some are calling quantitative tightening light. They're still buying bonds, but way less, targeting maybe around 80 trillion yen a year now instead of 120.
Okay, so the single biggest buyer in the market steps back significantly. Less demand means bond prices fall.
And yields go up because
Oh.
yields move inversely to prices. Basic mechanics.
Makes sense. Any other buyers stepping back?
Yeah, there are other factors. Traditional big domestic players like Japanese pension funds and life insurance companies, they seem less eager or maybe less able to absorb all the new debt the government keeps issuing, especially the really long-dated stuff. Regulatory changes might play a role too.
And what about foreign investors?
They've become more important, owning over 10% now. But the sources tend to describe them as a flightier crowd,
Meaning?
meaning they're more sensitive to global conditions, currency swings, what interest rates are doing elsewhere.
Mm.
They're potentially quicker to sell if things look shaky, which adds volatility. And we've seen signs of this weak demand lately in actual government bond auctions.
Like the government tries to sell bonds and
And demand is just weak, hitting multi-decade lows for some auctions. It's like the market is saying, thanks, but no thanks at the current prices or yields.
Okay, so you've got this, like, perfect storm brewing, massive debt making rising yields painful, the main buyer, the BOJ, stepping back because of inflation, other domestic buyers less interested, and foreign buyers being a bit jumpy. It really sounds like the Bank of Japan is caught in an impossible situation.
They really are. And this leads us to a really crucial concept the sources bring up: fiscal dominance.
Fiscal dominance. Okay, what's that?
Normally, think about it, if a central bank sees inflation taking off and bond yields spiking, what's the standard playbook?
Hike interest rates,
That's
right?
it.
Show you're serious about inflation, try to cool things down, stabilize the market.
Exactly. It's like, remember that doctor analogy you used?
Yeah, the painful but necessary surgery.
Right. Hiking rates is a painful surgery the central bank is supposed to perform to cure the illness of inflation or market instability, even if it hurts the economy in the short term. The market expects them to be able to do that.
But in Japan,
In Japan, because of that absolute crushing debt load, we talked about 263% of GDP, that rate hike surgery, it might actually be fatal. Not just painful, but fatal to the government's finances.
because hiking rates would make those interest payments on the massive debt just explode.
Precisely. A significant rate hike could balloon the government's interest bill to a point where, well, sources suggest it could trigger fears of a sovereign debt crisis, maybe even threaten the solvency of the state itself.
So the BOJ can't really hike rates meaningfully, even with inflation above target and the bond market flashing warning signs.
They're severely, severely constrained. This is fiscal dominance. It's when the government's borrowing needs and its massive debt burden effectively dictate what the central bank can do with monetary policy. The fiscal situation, the government's budget and debt, dominates the central bank's decision-making, overriding its usual mandate to control inflation. They're forced to keep rates low to keep the government afloat.
Wow, fiscal dominance. So the government's debt is essentially holding monetary policy hostage. That feels really significant.
It's a critical dynamic.
Yeah.
The consequences are huge. Because they're locked into these ultra-low rates, it just keeps fueling that yen carry trade, right? Borrowing yen stays dirt cheap.
Which keeps pushing the value of the yen down against other currencies.
Relentlessly. And for a country like Japan that imports almost all its energy, a lot of its food, a super weak yen means the cost of those essential imports goes way up.
So they're basically importing inflation because of the weak currency.
Exactly. It's a vicious cycle.
Oh.
The huge debt prevents rate hikes. The low rates weaken the yen. The weak yen pushes import prices up, fueling domestic inflation. But the BOJ can't effectively fight that inflation by hiking rates because the debt.
Ugh. And I guess hiking rates would also cause huge losses on all those bonds the BOJ itself owns.
Massive paper losses on their own balance sheet, yeah. Because when yields go up, the market value of existing bonds goes down, and they own over half the market. So yeah, they're truly caught between a rock and a hard place.
This whole situation in Japan, it feels unique in its scale, but the implications, they must ripple outwards globally, right? Given Japan's size.
Oh, absolutely. Japan isn't some isolated economic island. Remember, they're the world's largest foreign holder of U.S. government debt, U.S. treasuries.
Trillions of dollars worth, right? They've been a huge buyer for decades.
The cornerstone buyer.
Mhm.
So if Japan is feeling stress or if their investment calculations change, what are the sources saying about their appetite for U.S. debt now? Well, they're highlighting that Japanese investors, big institutions like pension funds and insurers, they've actually been pulling back from buying U.S. treasuries lately, sometimes even becoming net sellers.
Selling U.S. debt. Why?
A big part of it comes down to currency risk and the cost of hedging it. Think about it. The BOJ is possibly going to nudge rates up a tiny bit more. The U.S. Fed, meanwhile, might be looking at cutting rates eventually. That makes the exchange rate between the U.S. dollar and the Japanese yen USD JPY really volatile, unpredictable.
Okay, so if you're a big Japanese fund buying U.S. bonds, you want to protect yourself from the dollar potentially falling against the yen.
Right. You want to hedge that currency risk.
Right.
But hedging isn't free. And lately, the sources say the cost of hedging that USD JPY risk has become so expensive.
That it wipes out the extra yield you get from buying the U.S. bond instead of a JGB?
Exactly. It eats up, or sometimes even more than eats up, that yield advantage. So The trade just doesn't make as much sense anymore, especially for conservative institutions.
Wow, so that's a major spillover. Stress in Japan leading to potentially lower demand for U.S. government debt from its biggest foreign customer.
It's a significant link. And some observers, like macro analyst Weston Nakamura mentioned in the sources, they look at this trend weakening demand for government debt, starting in Japan, but potentially showing up elsewhere too, maybe even the U.S., and they see it as a broader warning sign.
A warning sign for the whole global financial system.
Potentially. They use the phrase canary in the coal mine.
Ah, the old mining analogy. The canary drops dead, warning the miners of toxic gas.
Exactly. In this view, the stress and the weakening demand for supposedly safe government bonds, particularly in a major economy like Japan, could be that canary. It might be signaling underlying problems, maybe dangerous conditions building up like a slow erosion of confidence, or increasing risk being priced into the very foundations of the global financial system.
Which is built on.
Fiat currencies and sovereign debt.
Yeah.
Government bonds are supposed to be the bedrock. If that bedrock starts showing cracks, even just in one major area, that's the concern.
Okay, the canary in the coal mine for government debt stability. That's a pretty heavy thought.
It is. And the sources presenting this view aren't necessarily screaming imminent collapse, but more like pointing to a potential slow, grinding reassessment of risk and assets everyone just assumed were perfectly safe forever.
And this is where some sources make that interesting, maybe unexpected link to Bitcoin.
Yeah, it's a fascinating observation highlighted by some. They noticed that at times recently, Bitcoin's price seems to have moved somewhat in sync with the yields on those long-term JGBs, both hitting new highs around similar times.
Wait, that seems weird. Why would Bitcoin, a volatile digital asset, track the yields on super traditional Japanese government bonds? They feel like opposites.
Well, the interpretation offered by some sources goes like this. Maybe both assets are reacting to the same underlying global force. If investors are demanding much higher yields to hold Japanese government debt, maybe it signals they're starting to perceive more risk in holding that debt. It subtly questions the whole risk-free status of major government bonds.
Okay, so if the traditional safe haven starts to look less safe.
Then maybe investors start looking for safety, or at least an alternative store of value elsewhere. The idea floated is, could the stress in Japan's bond market be a symptom of broader unease about the stability of the entire fiat currency and sovereign debt system?
And in that context, Bitcoin rising at the same time might be interpreted as what? A search for harder assets.
That's the hypothesis some put forward. Maybe some capital is flowing towards assets perceived as being outside that traditional system, like a scarce digital commodity, as a hedge against potential instability in government debt and fiat currencies. Japan's JGB market, in this view, acts as an early warning signal, a barometer.
That feels quite different from what happened in August 2024, doesn't it? Back then, Bitcoin fell sharply with other assets during that liquidation.
Exactly. In 2024, it seemed like Bitcoin was treated largely as a risk asset, something to sell quickly to raise cash when liquidity dried up. This potential newer dynamic, if the correlation holds and isn't just noise, might suggest something different. Bitcoin potentially acting as a counter-signal, rising because of perceived stress in the traditional system's foundations, with JGB yields being a key indicator of that stress.
But it's just a potential interpretation, right? The sources aren't all saying this is definitely happening.
No, absolutely not. And it's crucial to highlight the differing views. Some sources, like an analysis from State Street, push back strongly. They argue the JGB market issues are more technical, just market plumbing problems.
Like what?
Like deteriorating market functionality, driven by technical supply-side imbalances. Basically, the BOJ is buying less, other buyers haven't smoothly filled the gap, causing price discovery issues. They don't necessarily see it as some fundamental crisis of confidence in Japan's finances, more like market friction.
So under that view, the Bitcoin correlation could just be coincidence, random noise?
Entirely possible, yes.
Yeah.
And the sources are clear. Bitcoin's price is influenced by tons of other factors, its own narratives, its own market dynamics. It could easily see a downturn totally unrelated to JGBs or global finance. So it's a complex picture. These sources offer different lenses to look through.
Okay, wow. We've covered a lot of ground, from that initial market shock to the yen carry trade, the deep dive into JGB stress, the BOJ's impossible bind with fiscal dominance, the ripples hitting U.S. treasuries, and even this debated link to Bitcoin as a potential canary. So after all of that, what's the bottom line? What does this really mean for you listening right now?
I think the key takeaway is realizing just how interconnected things are.
Huh.
Markets that seem really distant and technical, like Japanese government bonds, they're not just Japan's issue. Because of Japan's sheer scale, huge economy, massive debt holder, world's biggest creditor stress in their core financial plumbing can send out really important signals globally.
Signals about what?
Signals about potentially broader shifts in confidence, confidence in traditional financial assets, like government debt, and maybe even in the fiat currencies those debts are based on.
Which leads us nicely to that sort of final provocative thought we wanted to leave you with, drawing on all these different signals and interpretations from the sources. If, and it's still an if based on the differing views, but if this stress we're seeing in major government bond markets, with Japan maybe being the leading edge, is a kind of canary in the coal mine for the traditional financial system, then how should you, as an investor or just someone trying to make sense of the economic world, think about the future?
Think about the future of sovereign debt itself.
Exactly. How do you evaluate the stability of currencies issued by governments carrying these enormous debt loads? And looking forward, what role, if any, might alternative assets like Bitcoin, for example, play if those traditional financial foundations really are being reevaluated by the market? What does all this signal about where value might be found or maybe where it could be lost in the coming years?
It really drills down to fundamental questions about money, value, and trust in the 21st century, doesn't it? And it's fascinating how these developments in Japan are bringing those questions into sharper focus.
Absolutely. And that's what we try to do here in these deep dives, connect the dots, unpack the jargon, and explore the big forces shaping our financial world.
Well, thanks for joining us on this exploration of Japan's bond market and its potential global tremors.
Yeah, thanks for tuning in. If you found this useful, please make sure you're following the deep dive wherever you get your audio so you don't miss our next one. And hey, a like or a share, always appreciated, really helps us out.
Definitely.
And of course, you can find more insights and follow What Bitcoin Taught Me pretty much everywhere online: Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.
Lots of places. Until next time.